Hello, ladies and gentlemen, and welcome to another episode of Trading for Life. After a major tumble in stocks, concerns are now shifting from tariffs to the bond market. A weak bond auction has left investors questioning how the U.S. will manage its growing debt load. The 30-year Treasury yield has pushed above 5% again. Historically, not a great sign for equities. Rising yields can put pressure on stock valuations and signal deeper issues ahead. With that being said, don't forget to like and subscribe, and let's jump into the news. We'll start with investors have been nervously watching rising Treasury yields since the beginning of May, and it looks like those concerns just came to life. On Wednesday, a weak auction of 20-year Treasury bonds pushed yields sharply higher, hitting levels we haven't seen since late 2023. This spike in long-term borrowing costs spooked markets, leading to a broad sell-off. As a result, major indexes logged their worst session since April 21st, according to Dow Jones market data. Rising Treasury yields rattled markets on Wednesday, as the 30-year bond yield surged past 5.09%, its highest level since October 2023. The jump came after a weak 20-year bond auction and reignited fears over the U.S. fiscal outlook. Stocks reacted sharply. Dow Jones fell 1.91%, S&P 500 dropped 1.61%, Nasdaq slipped 1.41%. High long-term yields often hurt equities by raising borrowing costs, and this time, markets didn't shrug it off. This is the season when bank stock investors watch closely for stress test results and capital return plans, including dividends and buybacks. Jefferies analysts launched coverage on 32 regional banks, with 3 rated underperform. Despite caution on a few names, the overall outlook is positive, citing loan growth, stable credit quality, and strong capital levels. Buybacks are also expected to support earnings and share prices. Over the past year, banks in the S&P 500 have returned 27.2%, far outpacing the broader index's 13.4%. Improved net interest margins, now at 3.28%, up from 2.55% in late 2021, have helped drive performance. A key debate in President Trump's tax and spending bill is how generous to make the state and local tax SALT deduction. The latest plan proposes a $40,000 deduction for families earning up to $500,000, phasing out above that. These limits would rise over 10 years. The SALT deduction, part of the tax code since 1913, previously allowed taxpayers to deduct all state and local taxes from federal income. That changed in 2017 when a $10,000 cap was introduced. The current proposal seeks to ease that limit for higher earners. Now let's review some data. We begin with guess what? The 30-year Treasury yield has just climbed to its highest level since the 2007 market peak. That's right, levels we haven't seen since just before the Great Financial Crisis. Is it a warning sign? A major shift in market dynamics? Or just noise? Hard to say for certain. But historically, spikes in long-dated yields have often been a red flag for risk assets, particularly when they reflect growing concerns over debt sustainability, inflation, or fading confidence in fiscal management. Probably nothing, but maybe everything. Short interest in the median S&P 500 stock has surged to approximately 2.3%, the highest level in 7 years. Short interest as a percentage of shares outstanding has jumped 35% year-to-date, a move comparable to early 2008, just ahead of the financial crisis, though from a lower base. According to Goldman Sachs, short interest has now exceeded its long-term historical average for the first time since the 2021 retail-driven short squeeze. Meanwhile, hedge fund short positions in Nasdaq stocks have climbed to 41% of total open interest, the highest since February 2021. The auction created a 1.2 basis point tail, the largest since December, according to Zero Hedge. The high yield of 5.047% marked only the second 20-year bond auction in history to clear above 5%. This sudden and sizable tail served as a wake-up call for markets, even in an already elevated yield environment. Why did this happen? A combination of macroeconomic factors are at play here. Between rising U.S. deficit spending, expectations of more inflation, and higher for longer Fed policy returning, rates are soaring. The U.S. is now running a budget deficit of 7% of GDP. Let's add more color to the conversation and look at some charts. Starting with the SPY 4-hour chart, the bulls are holding well so far. As long as this trend line holds, the bulls will win the battle. For the bears, we could see a pullback to 565. Next up, the QQQ 4-hour chart. The bulls had an incredible rally, but after today's sell-off, we could see more downside ahead. My downside targets are 504 and 486. On the upside, 540 is key, which corresponds to the all-time high. Now let's wrap up the video and take a look at what's on the calendar for tomorrow. 5:30 a.m. Initial jobless claims. 6:45 a.m. PMI manufacturing 7 a.m. The most important one, existing home sales. Make sure to keep an eye on these numbers. They could bring some volatility to the market. All right, ladies and gentlemen, that's all for this video. Hopefully you enjoyed it and found some value in the analysis. If you did, please like and subscribe. It really helps the channel grow. If you have any questions, feel free to drop them in the comments. Thanks for watching, and I'll see you all next time.